For those of you that don't know John, he's been with us. This is his third time with us. So we've really appreciated the time he's given us, the contributions he's made. He's a former CEO of Cable and Wireless. He has about 30 years of experience in telecommunications, including positions in Canada, the Caribbean, and Latin America. He served as president of Cable and Wireless's consumer division and chairman of the Bahamas Telecommunications Company. So, John, welcome back. We're glad that you're here.
Thank you, Mark. Glad to be back.
Well, we want to try and understand the state or the emerging state of telecommunications markets. So, and it's just primarily are issues of market structure, competition. And so I was wondering, so what your thoughts are for many years, probably depending on where you are in the world, maybe up to 30 years, more recently, maybe 20 or so years, we've been relying upon market competition to serve as the regulator in telecommunications. Do you see that changing?
Well, I think depending on where you are in the world, certainly, and perhaps the easiest thing to do in that respect is to divide it into the developed world and developing world. We're still seeing some competitive changes that I guess impact the regulatory environment, M&A as an example. I think if we focus though more closer to home in developing countries, that the reality is that, due to many factors, mostly size, being sort of smaller state countries, competition is probably the least effective tool that a regulator can rely on when it looks at balance and stability in the marketplace and oversight. And I think that that's not going to change. I mean, we've seen it in different countries and certainly in our part of the world here. And the reality is that a lot of Caribbean countries in particular are 100,000 people or less. We can take out Jamaica, Trinidad, and a couple of more. But the reality is that they're small. And so there are going to be a limited number of competitors. And so really from a regulatory perspective or an oversight perspective or a market stability perspective, the focus perhaps should switch to, what those competitors are doing. How are they investing? Where are they investing? What kind of coverage are they providing? Are they bringing new innovative services to the market? And, at the same time, are those markets being treated fairly from a consumer pricing perspective? And I think so. I really believe from a balancing perspective, the most effective, regulatory approach is to really focus on getting good investment strategies and long-term visions from the competitors, at the same time working with competitors to achieve a common vision for a country and really focusing on the benefits consumers and businesses can get over the long term.
So let's talk about that a little bit, because a lot of people struggle with the role of regulation when competition is weak. And we've seen some work on it, and we've done some in the US when I was a regulator. We've seen some done in the UK. You talked about this kind of creating a joint vision or a shared vision. How would you see that working, and how would that then be used to shape how the industry is performing and serving customers?
I think it's interesting because in my experience in this part of the world in particular, and again, it's probably because the market dynamics are so different, and the fact that there was an entrenched incumbent for decades in the sort of telecommunications space. And again, I'm focusing more on the Caribbean, but you could certainly say the same in many parts of Latin America where, government-owned assets and government and states owned telecommunications assets. And in some cases they still do, or certainly parts of them. And so that resulted in a lack of investment, really, a lack of innovation, and again, a real lack of customer focus. So what that sort of has brought us to today, and then again, we have a limited number of competitors in these markets, or certainly in most of them, is that there's a lack of trust. There's an animosity that exists within the relationship between operators and regulators. And I don't mean it's one-sided, and I don't mean it's prevalent in every country, but my own personal experience has been it is obvious. And so, when you start from a position of distrust on both sides, that it's very difficult to certainly, find a common purpose. And the common purpose, of course, as I alluded to, is really the betterment of the countries through investment, innovation, and maintaining a sense of stability in the marketplace that allows for incentives to invest while at the same time protecting consumers. So the first thing is this is the perfect time to do it. If you think about it, you take a step back, everyone understands, or they did before, the importance of telecommunications. But now we really sort of, now that the curtains are really pulled back, and this is not something that I'm just observing, obviously the world has sort of taken notice, the importance and criticalness of broadband in particular, infrastructure, and what that means for protection, for health, for economic development. So there's a great time to step back and to restart that dialogue, restart those relationships. And that's when you start with the focus, rather than on the number of competitors in the market. Well, what are those competitors doing? Are they in collusion or not? And I would say not. But certainly, you get past that stage, and then you focus on what is it that we as societies, regardless of where we sit in the equation, what do we want to accomplish, and to set out sort of those expectations, those incentives if they exist, but certainly changing the dialogue from how many competitors are in St. Lucia to what is the advantage of having the limited number that we have, and how do we get the most out of that for our society. So really it starts with resetting the clock, as it were, I think, on this relationship.
Thank you. That's really, really helpful. So see, as I understand it, you've sectored, if you will, or divided things along developed, developing, and small markets, large markets. I've got several questions. It just came from all of that, but let me go with this one first. So if we're having limited numbers of operators or limited competition in some of the smaller markets, developing country markets, what are the barriers? If regulators said, I want to make sure that we're doing the very best we can with a lot of rigorous, vigorous competition, what would you see as the primary barriers to that they should focus on?
Yeah, again, if we take a step back and we look at, the principal barrier to competition in small markets is that it's a small market. Economies of scale are so critical in the telecommunications industry, and the reality is because you're making an investment in a significant infrastructure that has to provide a return, and when the population is scarce, it makes it difficult. And if the population was scarce but in a very dense geographic location, the business model would look different. There's a reason why we still have the digital divide and why we still have challenging business models, is because in every country, and that's developed as well, investing in infrastructure to provide the coverage first and then the capacity second is very, very challenging. And so I think understanding first that, economies of scale will probably never ever get realized, or to a certain extent in some of these really small countries. It really has to focus on keeping costs contained and sort of the supply of that, and then how that translates into making sure the retail costs are also get the benefit of that cost reduction. Labor costs are traditionally lower. Power cost depends on the country, certainly, but the infrastructure costs, the investment in in fiber and access points, in facilities, they are the same, and they're actually probably it's probably a little bit more challenging because, again, from a supplier perspective, while there are some advantages obviously on scale, if you look at a Digicel and the cable and wireless, they still pale in comparison to the economies of scale that you would enjoy as an AT&T or a Virgin or a Vodafone. So I think understanding how that sort of plays then into the investment strategy. And Mark, I would say that it's probably pretty obvious that the two major players in the region, and there's others as well. There are there's TSTT in Trinidad, and there's Cable Bahamas in that country, and there's a few smaller players throughout the region that do compete. And AT&I is there, but again, they've got their own challenges. So, but if you look at sort of the financial performances of all those companies, whether they're private or not, and Digicel going through bankruptcy protection or restructuring, Cable and Wireless, struggling with, I talked about this on another session, 1% growth year over year. The focus is always on reduction of costs. And the reason that it's focused on the reduction of your operating costs is that your revenue is just not growing. And so, and the reason the revenue is not growing is that it comes down to a changing sort of environment with over-the-top players that is really having an impact on a lot of the businesses. Economics in terms of disposable income. And so if we look at sort of the limited availability or the limited ability to grow the revenue, at least significantly, the focus, while you're still having to invest hundreds of millions of dollars each year, these big players, then the business model just never seems to get quite right. So the focus is on cost. So it goes back to, again, understanding that, having two competitors, if you go to 5, does that make that any better in these countries? No, it actually makes things work. Now you have 5 countries or companies that will never get to economies of scale. The focus is always on cost. It will be less investment. And so there's a bit of a, it's a challenge. And so again, the focus, from my perspective, on the competitors that are there to focus on, again, prioritize investment strategies, coverage, capacity, innovation, maintaining a stable core to provide long-term benefits for the country seems the more practical way to go. So the barriers for these countries are economics and size, demographics. Anybody coming in is actually at a disadvantage even more than the incumbents because their economies of scale are even worse, in a worse shape. So they never get to that state of efficiency that they can actually sort of get above that bar to make those business models work. So I think understanding that is your starting point.
Well, that's really interesting. All kinds of questions come to mind. One of which is the idea of how important the number of competitors might be. I've not seen this argument made in a developing country, but I've seen it made in the United States, that even if we have to prop up with regulation a competitor, we're better off with that competitor than without. So this was very recent. We were having a merger between 2 very large wireless companies, T-Mobile, Sprint, and a group of economists wrote a paper that said we really ought to keep these separate, even if we have to prop one of them up and put it on life support. We're better off with 4 than 3. What are your thoughts on that for small economies, for the developing world, about trying to prop up a competitor just so that you have one, or maybe that you have 2?
Well, I would first state by saying that that's interesting. And of course, that merger was successful. So I guess it's an interesting development in the US. And we're still seeing those large mergers, and we see them elsewhere, which we can talk about. But, the reality, Mark, is that the balance sheets of these countries are desperate, and it's and I can say that without in a very knowledgeable way, but also certainly not not in a disparaging way. I come from a small island in Canada with 500,000 people that since the oil industry has sort of suffered. I mean, we're almost bankrupt ourselves. So I come from a place of hardship, and then I kind of moved the place, and I really understand and can empathize. And that's always the difference. One of the examples I'll give, Mark, is I live in Miami here, and if a hurricane rolled through the region, God forbid, in the next few months, and it hit some of the Caribbean islands and it hit Florida, well, in 6 months, you wouldn't know that there was even a hurricane in Florida. Whereas in the Bahamas or Antigua or somewhere else, they'd be years trying to get back on their feet. The fact is that the capital does not exist in the countries, and accessing capital, certainly without tremendous cost to these countries, is difficult. So, we have to be, I think, whether I agree or whether I would take a position on the ability, on sort of the premise or the argument that we should prop up competitors, I think probably makes some economic sense. Can they effectively do that in these countries? I would say is probably not possible. And so perhaps the focus should be really on the regulatory outlook and framework that does not provide or does not impose an undue cost on those operators. Because ultimately what happens is that whether it's through universal service fund or through the tax structure, or most of those costs get passed on to the retail market. And so, and I do understand that, again, what happens is, because there's such an overly focus on competition and LIRAC models and comparing small countries to regulatory frameworks in Europe or North America, the cost burden to do that and to really even strive to, be on the same sort of page is almost impossible. So what you have is an impossible task with an overcost regulatory body that ultimately only increases the cost for the ultimate sector that you're trying to protect. So I think understanding the sort of the environment from a financial perspective, whether it's the government or the private sector, is absolutely is really critical in how you develop the regulatory sort of framework for these countries.
All right, well, thank you very much. So for the audience, we're about to the point where I would like to see some questions from you. So for the next 15 minutes, if you would start putting those in the chat. After that 15-minute period, then we will be opening the microphones for people to engage in much more of a discussion. But please do give us any questions that you have. In the meantime, I still have some of my own, but yours are more important than mine. So John, when you were a CEO or an executive in the company, you felt different kinds of competitive pressures depending upon the market you were in. And giving that thought about, competition is going to be different in different places. What did that feel like? What did that look like? How did you think about that when you were making decisions?
Ultimately in any company, in any position, there's internal sort of conflicts. I'll use the word conflict. It's just in terms of how you strategize and how you deal with issues. I believe that, from my perspective, looking back and reflecting on my career, the first thing that, I would have to observe, and I would, is look at it on a holistic basis and look at it beyond a quarterly basis. And so ultimately developing a strategy is very difficult from a performance perspective if you're a publicly traded company, because there are always internal challenges or internal views on how you respond in the short term versus the long term, because the market can respond. That being said, if you look at the competitive landscape, and get a good view on what those competitors are doing, the first thing that I would reflect on is how much are they investing? What is their focus? What is their vision? Are they investing in mobile? Are they investing in fixed? Are they investing in both? Where are they investing? Why are they, not why, but you'd certainly get a view as to if they're investing in a certain geography, what are their expectations that are different from our own? What kind of market share do their business models require them to achieve based on that investment compared to what our investment models would be? Are we on the defensive or are we on the offensive? In other words, are we the incumbent that's sort of expect our market share to go from 72% down to 47%? How do we manage that model? Are we the challenger? And do we look at markets where our market share will be lower, or we're going to the market for the first time, and how we can get to a certain point that satisfies the investment strategy? Ultimately, what happens from a product perspective, or from an innovation perspective, I will call it, you're a quarter behind at the most. Your suppliers tend to be the same. You're investing in new technologies, whether it's LTE or 3G before that, or now 5G. You get a view as to what the investment strategy is, and you're never far behind. From a pricing perspective, are you taking pricing or are you giving pricing? And again, you're only literally a couple of months behind on fixed, and probably a month behind on mobile to understand, are there things going on the pricing side that you need to respond to? Mm-hmm. So it is fluid. In multiple countries, it's the same analysis, but it could be a different dynamic. But ultimately, dealing with the short term, but more so from a pricing packaging perspective, the long term from an investment perspective, that's sort of the two lenses that you would normally have on.
All right, well, thank you very much. We do have a question from Lee Tuthill. Lee says that what consumers are really most interested in are affordable prices and maintaining contestability in the market, which is a word for the intensity of price competition, even with fewer licenses, could help consumers to get those things they want. So as a question, he has, how could that be received? And then as a second question, what about the virtual mobile network operators or resellers? So what are your thoughts on that? How could, if that's the objective, is that contestability, that intense price competition,
right?
How would regulators pursue that?
Well, I'm a firm believer in unless there's a market dominance, unless there's market dominance, and in some particular cases there probably is, especially for fixed voice, but it's become less a relevant service. So maybe the regulators is not focused on that as much as others. If you look at broadband, if you look at video, which is using an old phrase, is a bit of a dog's breakfast, especially with OTT. I think my position is that the consumer is the ultimate competitive leverage when it comes to pricing and pricing controls. And I don't mean in a perfect world, and I believe in most worlds are perfect when it comes to collusion or certainly, matching prices. I don't think it really, well, I know it doesn't exist in terms of a strategy, and I know it doesn't exist in terms of my own experience. If I make that assumption that they're working independently, then ultimately, and in developing countries, you only have so much room to grow your revenue through pricing. And I've seen it time and time again. You focus, so, how do you manage that from a regulatory perspective? Well, I think, again, if there's single market dominance, or if there's market dominance within a certain sector, then perhaps having that oversight to ensure that pricing remains affordable should be a priority. But that's again, it's not common when you look at most of the services, mobile, broadband, video, or certainly in commercial services. So I think ultimately we have to take a look again at the cost of providing the service, and you look at the competitive landscape, but importantly, you look at the demographic profile and the ability for people to pay. It's been said, many times in my career, I've got 20, as a consumer in a prepaid market in Jamaica, which is 90% prepaid, I've got $20 to spend a month. The price goes up by $5. I've got $20 to spend a month. I'm not going to spend more. I'm going to spend what I have. I'm just going to spend smarter. So that's the challenge an operator has. And that's why if you look at pricing perspective, and you're right, pricing is the ultimate concern. That being said, consumers are also very cognizant of the fact that they want new technologies, they want more bandwidth, they want more. So pricing is certainly an important part of the equation. The consumers are smart enough to know that if I want more, I probably have to pay more for a better service. So I would counter with that point. Mm-hmm. But again, I don't really think it's an issue from a regulatory perspective unless there's dominance in the market. And that's when perhaps finding that right lever to ensure, pricing stability from a consumer perspective is enforced somehow. The mobile perspective, MVNOs, we've seen it work elsewhere. It's not really, certainly not common. We were approached years ago, I know, at Cable & Wireless, because we knew a couple operators in Europe that were going through the same process, and a third party had approached us. We didn't enter a partnership with us. It was certainly not enforced. We did look at the opportunity. We just didn't see the benefit from an operator perspective. But certainly, it's not uncommon. It's successful, and certainly in different markets. From a consumer perspective, what I can't recall, and I don't want to speak out of ignorance, is certainly the wholesale pricing structure to make those models work for both parties, and how the regulator kind of sets the tone on that. Again, the wholesale cost will probably tend to be higher in developing countries, just inherent in the cost structure. And so could that model work, and that what the benefits would be to the consumer? What I will say is, if you don't mind, Mark, is we have seen a third operator, one of the largest in the region, come to Jamaica, Claro, years and years ago, and ultimately Digicel bought the business from them. It was sort of a retaliatory move from Digicel going into Central America, as you may recall, but they lost a ton of money. Mm-hmm. There is a strong sense of loyalty between Flow or Digicel in these markets. It's almost like the beer industry I used to like, and when a percentage point used to go one way or the other, it was huge for the beer industry. It's not so much for the mobile industry, but moving 2 or 3 points either way would be considered a massive sort of market shift. It doesn't happen very often. It kind of tends to go like this. It'll settle. Digicel came into Jamaica 15, 20 years ago and ate Cable & Wireless's lunch at that point. Cable & Wireless has fought back to probably 25, 35% market share, but now it's sort of hit that sort of point where people just don't move. Or if they move back and forth based on the offer of the day. So having an MVNO structure, I'm not quite convinced it would be successful for either party.
That's interesting about the consumers becoming loyal to operators. That can change dynamics quite a bit. So we have a question from Victor. Victor's from Ghana. He's been one of our students several times. I know Victor well. Victor's the kind of person who likes to set a vision for how things should be and then tries to pursue that. So his question is, when he wants to look at other countries to learn from, should he be looking to developed countries, Europe, the US? Should he be looking at Caribbean, Latin America? So he's from Ghana. Where do you think he would learn good lessons?
Good question. I think developed countries are useful to look at if the size of the country, even in developing countries, is relevant. In other words, from a perspective of population and sort of density and the ability to build a customer base, a client base that's considered large, that economies of scale can be achieved, looking to the developed world is helpful. At the same time, if you look at dynamics, country health, demographic profile of consumers, commercial activity, bandwidth costs in terms of capacity costs, then looking to developing countries, I think it's more relevant, more pertinent for these operators. So again, there's two sides of this. Having the economies of scale while operating in a developing country, that would be a model that's not unique, but certainly not consistent with either of the two domains closer to my background, which would be North America or developing. So it's sort of a marriage of both, but I think from a perspective of regulatory, it may be more of an understanding of developing countries, but at the same time, looking to some European smaller state countries that would have a more progressive and effective regulatory regime because they've been in existence for a long time, than certainly I think in the Caribbean, where the reality is, as we've spoken before, Mark, is that there is no consistency between countries on regulatory framework because all the countries, except for a small Eastern Caribbean chain, is dependent on sort of that regional body. That's another weakness, unfortunately. So looking at it from a regulatory perspective, I think, looking to those established countries of similar size, but maybe in a developing country, would be the best approach.
Okay, well, thank you very much for that. Fairly soon, we're going to be opening up the microphone, so people might be thinking about their interest in that, but I still have a few minutes of taking questions off the chat. This is from Juan Fanel, and I apologize if I pronounced your first name incorrectly. I'm really bad about that. So the question for this is, suppose that in the next 2 to 4 years, just because of the financial stresses, you were to lose an operator in the Caribbean, how do you think the governments would respond to that?
Oh, that's a great question. I don't think we'll lose an operator. And Digicel may be the one that pops up here because that's the only one that really be of significance. There's smaller operators that could get gobbled up, I suppose. One is that companies that go into bankruptcy, especially with sizable assets, don't tend to sort of go away. They just get restructured, and the cost of capital gets higher, and perhaps there's more kind of stress on the local operations and labor. But again, I think they've gone through all that, to be quite frank. So I don't think that will change. It'll look different. And what could happen to that respect, though. But I'm saying this, but it's probably more rhetorical. I don't think governments would go back to taking a stake in an asset. They could. I just they all own something at some point, and again the government still through TSTT still owns a piece of that. In the Bahamas, of course, they own a piece of both operators, so that's interesting. And there's other countries that still own sort of a piece of a pie, I guess, as it were. I think the challenge right now is just having the financial wherewithal to do it. There's probably conflicting views on that because, again, coming out of the virus, there is that sense of urgency to provide coverage and capacity, for lots of different parts of the countries that are underserviced. So I think there's probably a certain contingent within, the government executive and stakeholders that would love to get back into the industry just because, it's seen now more quasi-utility, as we've talked before. But I just don't think that's going to happen. I think if one were to fail, I think you'd certainly find, you would find governments probably trying to scratch around to find a way to save that asset, either through ownership or through some other sort of financial contributions. I don't think it's possible, the latter part, and I don't think it's probable taking a stake. But at the same time, the last thing the government would want, especially if there's no suitor lined up, is to see a low competitive environment or a poor competitive environment become worse. But I don't think that'll ever happen. And listen, there's always private equity guys who are waiting to pay for 50 cents on the dollar for an asset. So I think that'll always work out.
All right. So one more question that I'll read off. And this is from Carrie. And this may be something you're not familiar enough with, because it's very much a question about the U.S.
Okay.
And it's about what we call BDS. It's called Business Digital Services. We used to call it Special Access. Essentially, it is a digital line that people involved in internetworking would lease from a local telecom company to provide business services.
Right.
And at one time, these prices were regulated. The FCC recently loosened up those regulations. And so Carrie's basic question is, do you ever expect that regulation to return? And if you're not real familiar with how the FCC does that, maybe a way of framing that question is, if a regulation is withdrawn and prices rise, how do you think a regulator might respond to that or should respond to that? So they've loosened regulation, prices went up, and should they respond and say, oops, wait a minute, that's not what I meant, or do something different?
I guess the easiest way for me to answer that would be to punt it back to you, but I won't, since I'm the invited guest. Listen, I think what we're seeing in the U.S., and Mark, you are the expert here, I'm not, but certainly the change of administration and then the change of personnel in the FCC and net neutrality. There's they're probably more aligned than I think than one would like to see. But at the same time, the Obama administration focused on net neutrality. And so if you look ahead past November, you might see this problem return again or reverse again. But at the same time, I think in the United States in particular, it's probably the most highly capitalistic structured country in the world. It's focused on survival of the fittest. It really is. And I'm from Canada, and there's so much differences between the two countries in terms of the regulatory perspective and oversight, and sort of this really is a market-driven economy, a market-driven focus for much of the policy, it seems. And so that's just the history of the country. At the same time, I would think, like any good policy or bad policy, they get reviewed from time to time. And if there is an opportunity to tweak a policy to provide more oversight, you'd think the onus would be thrown back to the regulator to do that. But given the complexities and the sort of the difference in views on that from a political perspective, that's not easy. That's more easily said than done. And I think that it takes a long time to change a policy. So to go back and reverse it may be the ideal solution, but there's probably no quick fix of that happening, and certainly circling the wagons and getting everybody on board. But from my perspective, obviously, it goes back to the argument of a stable market and open access, and at least the opportunity to have a viable competitive state should be in large economies should be the focus, because the infrastructure incentives are there, the economies of scale are there. So the regulatory framework should support that, as opposed to a smaller economy where the focus should be less on the number of competitors and access, and really trying to tighten up that approach with those limited number of competitors. So I would love to see it in a utopia kind of environment for regulatory, that consistent oversight is given, and perhaps it does. You're the expert, you can answer that. And at the same time, policies that seem to be in need of being tweaked, they should be tweaked. But again, that's easy for me to say.
Okay, well, thank you for that. And Carrie, I was never involved in that particular proceeding. I do know a lot of economists who did studies for that proceeding. And I'll tell you, their perspective was that they actually expected prices to rise, and they were arguing that was going to be a good thing, because the regulation was keeping competition from entering and limiting investment, both from competition and the incumbents. If you are concerned about how things have gone, those are the two areas I would look at. I would say, well, I would look at how has competition emerged in any of those markets, and have investments indeed expanded? So those are the things I'd look at if you were concerned about what the FCC did and its impacts. All right, so Sam, could we open up the mic, please? I know we've got some people who, Emmanuel and Lee, both have questions. If they're willing to verbalize those, that would be great.
Sure, absolutely. So I sent a message to Emmanuel, but he hasn't gotten back to me. So I'll go ahead and see if we can unmute Lee. You have to ask to unmute, so we'll see. Hi, Lee, can you hear us?
Pardon?
Can you hear us?
I can hear you. Can you hear me?
We can, yes. Thank you so much. If you'd like to share your video, please feel free. If not, that's completely fine as well. So you're on the mic now. We can hear you.
Yeah, okay. Well, I'm in my kitchen. I'll leave the video off. I work at the WTO, where I've covered telecom since we had negotiations on that. And one of the commitments that many of the governments in Caribbean and other developing countries have taken is commitments not to proactively or explicitly limit the number of suppliers. So, and many of them have been disappointed perhaps that they don't get some healthy competition going. But in that respect, even when there ends up being de facto one or two suppliers, I think that perhaps the possibility that if you haven't closed out the opportunity to license additional suppliers if the need arises, or if you think that may solve some of the problems, I think that could perhaps create some of this contestability that I was referring to. What's your opinion on that?
Okay, Lee, I'll probably need a little bit more clarity. So governments don't restrict, and they promote certainly, a number of suppliers to provide the relevant, relevant support and services for the region. And you're saying that some that still kind of closes the door on others where they don't see as many opportunities. So I'm trying to get to what the question is again. I'm sorry.
Lee, could you explain some more what your
question?
Of
deciding that one is fine. And most governments in the regions you're talking about have taken commitments, many of them, that they will not themselves limit the number of suppliers.
Okay.
So that's the background to that. And so you can't just tell people, go out and say, well, we're going to decide how many suppliers there will be based on what the government thinks will achieve economies of scale. That really wouldn't be possible to begin with. So even you can't get more suppliers and you're happy with the number you have, still I think the idea that possible additional licenses isn't closed out can help in the regulatory sense, keep the suppliers you do have on better behavior, perhaps.
Now, you from a supplier perspective, are you talking about the service? Are you talking about the operators or the suppliers to the operators? I'm sorry, I'm a little confused.
I'm talking about operators, be they mobile or fixed, essentially.
Okay, all right.
Yeah.
I don't know how to answer that besides what I've sort of talked about before. I don't know how you get to economies of scale if you increase the number of operators. And you're right. I mean, but I think that sort of answers it, doesn't it? If potential market entrants don't see a viable opportunity, then they're not going to. And I don't think it's from a regulatory perspective, because I think most regulators would love to see more. Most would love to see more operators in the environment, despite my thinking that that's probably not plausible. But I don't know how the governments, in my experience in the last 15 or so years being around this region, there's always been the focus and the priority of governments or regulators to try to entice new operators. We do see it in some of the local operators. You see it say in Trinidad, where Green Dot, wireless provider. So we had Digicel, we had TSTT, fixed line, we have Flow. Then we had Green Dot come in with some 700 megahertz space spectrum, I think, awarded to it, and they provided some wireless services. They've been subsequently majority sold to OCM. Then we had Massey Communications, which is part of, as you know, probably a huge, conglomerate in Trinidad. Entered the fixed line space, lost a ton of money, and was eventually sold to TSTT. Again, I talked about Claro going into Jamaica from a wireless perspective and just couldn't make it work, despite you have to think based on certainly the supplier part of their value chain having more economies of scale than anyone in the region. And so I don't know, I'm not quite sure how you can entice entrants to come to a market where the market itself is just not structured or is not of size to support, numerous players. I think that's inherently the challenge. I could be wrong on this. It's just my own experience and looking at the performance of the companies that are there right now and what they're struggling with. It's, creating a more competitive environment doesn't necessarily change the outcome. And in fact, what it does is that it disincents those existing operators, but probably more importantly, their chance of economies of scale only diminishes with more entrants. I mean, I think that's ultimately the hard view on this region from my perspective anyway.
All right, if I could just add to that a little bit. So as I understand what Lee is asking, it's can we use the threat of competition by making it easy to enter as we can, the threat of competition to provide at least some market discipline. One of the keys to that, taking from John's answer, is we have to fully understand the business case for entry. So the government can take down all kinds of barriers to entry, but if the business case is not very good, then the incumbent operators will know that, and that doesn't then provide very much competitive pressure because the threat is not very real.
I can add to that, Mark, just very quickly. And again, this was, our discussions. And when we view, because you asked me a question earlier, how we view competition. And I will tell you that I came from Columbus Communications prior to Cable and Wireless. And after 10 years, our company was sold. And when I then, when we saw Digicel even entering the fixed line space way back when, we even questioned that business model, I will tell you. Now, we understood it. Mobile is going through a lot of disruption. It continues to do so. Data is going up, voice is going down, but marrying that with and monetizing that, it's been a challenge for the industry. But we looked at that as a time when the cost of the build out is prohibitive in small countries, and we looked at it the video business just going down in terms of its importance in the business model, lower margins, and just the cost to provide those services. And that's continued. We even questioned their strategy. And of course, I'm not saying that it's led to, 6-7 times EBITDA debt and bankruptcy, but I will tell you it probably hasn't helped. And had their market share got to the point that it satisfies their own business models, we won't know that because they're a private company. But even in that perspective, we question the strategy of a major telecom player in the market who had a loyal customer base, who was focused on an FMC strategy that we doubted at that time could be successful. And so, looking at it from that lens, and then looking out beyond others trying to come in and replicate that, even with some sort of an open access model, but with higher wholesale rates, it's just difficult.
Okay. All right, well, thank you very much. Sam, have you heard back from Emmanuel?
I have, yes. So I just wanted to touch base with all of our participants just to let you know. So this portion is, like Dr. Jamieson mentioned earlier, we would love to hear from you all. So in order to do so, if you're using a laptop or a desktop, you would go to the bottom of the Zoom toolbar to the participant tab, and there's a hand icon that you can select, and that will prompt me that you would like to share with us. And so then I will unmute your audio, and you're free to share your video if you'd like. I'll also send just an update of that in the chat again so everyone has that. But yeah, so right now we're ready for Emmanuel to share. I'm going to go ahead and unmute you, Emmanuel. Just let me know if you can hear us.
Yes, I can hear you. I'm thankful for the opportunity once again to learn from you.
Hey, Emmanuel.
So, in Ghana, the issue about what is the optimal number of operators has also been topical. We are still discussing how many operators are optimal in the market. We're having 6 now. There has been a consolidation. We have 4. We are still discussing whether 4 is optimal or we need to consolidate further. This afternoon, that is not my question. I'm asking about significant market power. In a developing country like Ghana, what will be your advice in the approach to regulating if an entity is classified as an SMP?
Right.
Also, the literature really provides some kind of remedies, but it's mostly in the voice market, the voice retail market. There hasn't been much as far as the data market is concerned. And so what would be your advice in regulating, especially in a developing country like Ghana? The market is not so much saturated or matured. It is still evolving. And if an entity is tagged or classified as an SMP,
Right.
how will you advise that such an entity be regulated? Thank you.
Yeah, I believe, even though I haven't spent any time in my career in government in any capacity, I understand and I recognize the importance of the regulatory oversight of telecommunications industry. And because they represent the people, not so much the government. They shouldn't. They should, but they should. They should represent, the good, what's good for their country and for the people. I think in a single market, in a market where there's a dominant player, then there's a perceived opportunity and demand for another or more operators, then the government should be more proactive on developing open access policies. And with, again, getting right to the point of how you establish and work with operators on those wholesale rates for access, and making sure that that all the stakeholders, whether they're the existing operators, whether they're the entrant or the new entrant that's interested in providing a competitive service, and the consumers, the end sort of the user, all benefit from that, or certainly are all considered. And because if the risk that you do have in a market where there's limited competitors, but at the same time you have a dominant player, if the market itself is not sorting itself to sort of split that market share based on investment and customer experience and again new products and innovation, if that doesn't take itself a normal course to sort of right itself, and so 78 or 80% goes down to 55%, whatever is appropriate or seen as, certainly I won't go by the definition of sort of market dominance, I'll go by what the market kind of seems as sort of an equal kind of framework or environment. Then the government should focus on, if they can't remedy that situation by and I don't know how you would in terms of, without some sort of price controls. You can certainly do that from an oversight perspective to protect the consumer, but at the same time, you're still left with the market dominance position. I think you have to focus on a strategy to entice other operators to come in with a very, with the right policy, the right framework, that their investment, regardless of what it is, even as an open access service provider, their operational certainty investment that they'll require is seen as something that pays off for them. And I think that's, I can't give any examples as to how that works in terms of business models as a per se, but I do understand, and we've gone through sort of in my career situations where we had to open our pipes, as it were, to provide access to an existing competitor. And facilities, shared infrastructure, network infrastructure. I've gone through all that. I think that's going to be probably more prevalent in the future than it has in the past. But I think the government, the regulatory body in Ghana, should look for opportunities to create more competition. I think that's the situation in a market where there's a dominant player. I wouldn't say you'll work it out with the existing dominant player. I think you really got to, but at the same time, it's not penalizing the operator. It's really rewarding the consumer and changing the dynamics of the market, which then will also help with the investment and incentivization of companies wanting to invest and provide better service. Mark might have a view on that as well.
Okay, well, thank you very much, John. Emmanuel, you might go back and, well, let me reframe this. So John, in a moment, I'm going to go back and ask you more about the infrastructure sharing, because that is one way of dealing with some of the economies of scale and such, and get your experiences and ideas. Emmanuel, you might go back and look at, if you still have the training materials, that David Sappington provided in our 2-week course for the telecom group. He gives a case, this was a case in the UK, where the concern was there's not enough competition for very small customers. And so they developed a price cap explicitly just on those. Everything else in the market was allowed to go. So they zeroed in on just those customers. You might go back and look at that. And if you can't find it, let us know and we can get all that to you. But that's, if none of your underlying remedies help, then that is a way of protecting at least the most vulnerable customers. So John, you were talking earlier. I don't see any question. Do we have any hands up, Sam? No? Okay. So John, you were talking about ways of addressing this, this challenge of the economies of scale and entry. And you talked about you had experiences with infrastructure sharing. We plan to have 2 whole sessions on that in the future, where the 2 experts get together and we'll talk, and then some regulators will talk about that as well. Would appreciate your thoughts. You were the operator, you experienced that. What works, what doesn't? How does it play out from your perspective?
I think one of the conditions. I'll give the most recent example that pops to my mind, and with either the Columbus transaction and the approval required in Jamaica, or because we had to get approval in a lot of jurisdictions, as you can appreciate, or the cable and wireless of Columbus, or the Liberty of Columbus. I think it was the first. I think it was cable and wireless and Columbus, because it was more of a heated process, obviously, because we were in some of the smaller countries actually taking the competitor route. Liberty was really just putting a new name on the building. One of our requirements was, besides ensuring that operators had access to international connectivity, at a fair and reasonable price, and that would be established. And I can't recall the exact wording, but that was one of the requirements of the sale of the transaction. Cable and wireless through Columbus, we had an extensive fiber network that hit 42 countries, and so we were the main supplier of broadband through the Caribbean and even most of the Pan Am region. So, but in country, we also had a regulatory requirement to provide access to the competitor, the prime competitor, which was Digicel. And so, while Digicel was busy building out its own fiber infrastructure, to go back to my previous point on how viable that was, we weren't quite convinced. Obviously, having the opportunity to have access to existing infrastructure made that business model look a little better. And so, again, one of the requirements was to, in certain parts of the country, to share or to provide that access to facilities and to infrastructure. The most difficult part of that was, of course, creating a working document with access, with service level agreements and pricing to make that work. It was left to the operators to do that, which I thought was the most beneficial way to do that. If the regulatory environment certainly was stable enough to allow operators to enter into a commercial agreement, that obviously would be beneficial with compromise to both parties rather than it being enforced. And so it was a long and truncated process, I do recall. At the same time, it did provide a solution to our regulatory requirement, and it also provided both major players with an agreement to share infrastructure, some ducting. I can't recall, again, how extensive that was, but I do actually, if I do reflect on it, I believe it was also tied to a larger agreement then that took us out of Jamaica through some Caribbean countries, where then we shared some of the tower infrastructure on the mobile side. So what that allowed us to do, I guess, it is in several countries now, is that both parties actually took that as sort of as an opportunity to look at where efficiencies could be achieved, and I guess from both parties to share other infrastructure besides just having regulatory required open access, I guess, as it were, in certain parts of the backbone in Jamaica. So it did turn out to be a bigger agreement, and it was done between the two parties, which was I guess the proper way to do it.
All right. So we have time for one more question. Victor has his hand up. So Sam, I'll turn it over to you.
Yes, thank you so much.
Victor?
I've
Hello.
asked, hi, Victor. Okay, great. Thank you.
Yeah, can you hear me now?
We can, yes. Thank you so much.
Yes. Thank you, John, for this important experience that we are learning from you. My question is that when you were in cable and wireless, how do you assign capital expenditure to the various countries that works under you?
That's good. So I'll just make sure I framed it up right. So what you want to know from cable and wireless perspective with assets in 25 countries at that time, how did we set budgets up for each country? Is that what you're asking me?
Yeah, that's right.
Okay.
That's right.
No. You know, it's interesting. Obviously, each country, despite maybe some clusters from a management perspective, they're all individual, profit and loss centers. Basically, they're like a franchise, I guess, in the sense that each one has its, operating model with its own cost base, and in most cases, don't send money up to the corporate parent. I mean, that's the way it works because of the corporate cost. We didn't generate any revenue. So those were all set business models. So we were establishing, so let's look at budget 2021. We'd already be sort of looking at that, and first drafts would be coming at the end of August, and then we beat them all back, of course, and beat them down, and they'd have to come back and sort of, put in ones that we felt were more reasonable based on their growth opportunities and investment required. And then of course, it comes to a point of in-person presentations long into the process, and then finally board presentation once we're happy as a management team. But to get to that point, there's a very, very strong individual competition between countries. So there's like any company, or there's a scarcity of resources, especially from the invested capital perspective. And so each of those countries, you would have basically a steady state part of the budget that says, if we do nothing next year, this is what we can achieve in terms of revenue and earnings. And then you would scale up by adding on capital projects to sort of to vet, and then they would sort of be embedded into the budgets, and then you would look at it from a different lens. And some of that, of course, most of that revenue or that capital would be generated locally. Obviously, it comes from their own sort of revenue generation machine. And sometimes, of course, based on the opportunity and based on where we felt money needed to be invested, you would basically take from one to give to the other where you saw the opportunity. That was really very rare. Mostly they all had to stand on their own. So if Antigua had a budget of top line of X and it had sort of a free cash flow before investment of Y, they would have to build a business case based on what we need to have to keep the lights on, what we would like to have to sort of grow our business, and here's our additional wish list. But it is at the same time, it's still very much a competition, because while the capital is one thing, having the ability to execute a capital plan is just as difficult. And I will tell you that in many years, having the ability to develop the business plans, establish the supply chains, all the logistics, considering your day-to-day operations, investing the capital, having the crews, doing whatever, that's where at the end of the year, of course, some projects just did not get completed, because it's one thing to assign capital and it's the other thing to be able to execute the delivery of that capital. The problem with that, or the risk of that, is not delivering the capital, is that it impacted their growth projections. So if we were going to invest $10 million in Montserrat on infrastructure development, then that $10 million had to find its way back into how that's going to impact our revenue growth, obviously, correct? Right? Through subscription, through additional ARPU from existing customers, through commercial opportunities. If that capital didn't get deployed, then obviously their budget was down here, and so they missed their targets. And so again, and that's not uncommon in countries with lots of assets, because it's a difficult oversight procedure, and it takes resources always outside of the country. The expertise, the contractors, the local internal expertise, so developing. So that's what I would say, Victor, is that it's a process where you develop the budgets internally. You would have your oversight and get vetted and signed off. But just having that ability to execute that capital after a very stringent review process, that was always as difficult as sort of giving the green light to spend the capital.
Okay, well, thank you, John, so much for again another hour of your time. This has been a tour de force. made lots of notes. This has been amazing. I appreciate it very much. And thank you everyone else who's participated.